starting July 1st, 2025. 3 federal changes take effect at the same time, and together they could cost the average American retiree $4,200 or more in the very first year. Not because you did anything wrong, not because you broke any rule, but because the system changed and nobody told you. Here is what most seniors already know. Medicare premiums went up again. That is not news. Here is what most seniors do not know. Number 1. The IRS updated the income threshold that triggers Medicare surcharges. That threshold is lower than most people think. If you took any money out of your IRA this year, even for something completely ordinary, you may have already crossed it. Number 2. The Social Security earnings test limit was adjusted for 2025. If you are collecting Social Security and still working any hours at all, there is a specific dollar figure you cannot cross. Most people do not know what that number is. And number 3, I am going to hold this one, because once you hear it, you will understand why I saved it. It involves something almost every retiree does automatically, and it is the one change catching the most people off guard this July. Your bank did not send you a letter about any of this. The Social Security Administration updated its own internal guidance in May, and nothing was mailed to beneficiaries, not one envelope. In the next 18 minutes, the 3 July changes in plain English, a real client story of a 67-year-old who almost paid $888 a year she did not owe, 4 specific moves to protect yourself before August, and the one number every retiree must memorize. Stay with me. This matters. My name is Marcus Graves. Here is one thing worth understanding right now. Your bank earns more when your cash sits in a low-yield savings account. That is not a conspiracy. That is their business model. Keeping that in mind every time you talk to a financial institution will save you thousands over your retirement. Everything I share today is documented and verifiable. Every law I cite, every dollar figure, every form number, you can look it up yourself. I will tell you exactly where. Let me show you what these July changes look like in real life. I want to tell you about Carol. Carol is 67 years old. She spent 31 years as a school librarian in Albuquerque, New Mexico. She retired 4 years ago with a modest pension, a Social Security check of $1,840 a month, and $112,000 in a traditional IRA. Carol is not wealthy. She is careful. She reads every letter Medicare sends her. She files her taxes on time. She keeps a paper folder with every financial document organized by month. Last June, her central air conditioning failed. In Albuquerque in summer, that is not optional. The replacement cost $14,000. She did not have that in cash, so she called her IRA custodian and requested a $14,000 distribution. Her money, her account, completely legal. She paid the income tax on it and reported it correctly. She did not know, because nobody told her, that this single withdrawal pushed her modified adjusted gross income over a specific federal threshold. That threshold determines what Medicare charges for Part B coverage. 5 months later, Carol received a letter from the Social Security Administration. Her Part B premium for 2026 was increasing from $185.00 per month to $259.00 per month, $74 more every single month, because of one IRA withdrawal to fix her air conditioner. That is $888 per year, for doing something completely ordinary with money that was already hers. Carol set that letter on her kitchen table. She did not know whether to appeal it, pay it, or call someone. She assumed the government sent you a number and you paid it. I am going to come back to Carol before this video ends, because what happened next surprised even me. But first, you need to understand exactly what caused this, because one of these mechanisms may already be affecting you. Change 1. The IRMAA threshold. IRMAA, Income-Related Monthly Adjustment Amount, is the surcharge Medicare adds to your Part B and Part D premiums when your income exceeds a certain level. The income Medicare uses is not your current income. It is your income from 2 years ago, as reported to the IRS. In 2025, Medicare is looking at your 2023 tax return. The Tier 1 threshold for single filers is $103,000. For married couples filing jointly, it is $206,000. If your modified adjusted gross income exceeds those numbers by even $1, your Part B premium jumps from $185.00 to $259.00 per month, automatically, with no warning in advance. Change 2. The Social Security Earnings Test. If you are collecting Social Security before your full retirement age 67 for most people, the SSA limits how much you can earn from work. In 2025, that limit is $22,320 per year. If you earn more, Social Security withholds $1 for every $2 over the limit. That money is credited back at full retirement age, but the short-term cash impact is real, and most working retirees do not track it monthly. Change 3. Required minimum distributions under Secure 2.0. Here is the one I held back. Under the Secure 2.0 Act, Public Law 117-328, the RMD starting age moved to 73. If you turned 73 in 2025, this is your first RMD year. Here is the trap. You are allowed to delay your first RMD until April 1st of the following year. That sounds like a benefit, but if you wait until April 2026, you must also take your full 2026 RMD in that same calendar year. 2 full distributions in 12 months. That income spike can push your MAGI well above the IRMAA threshold, triggering Medicare surcharges that would not have happened if you simply took the first distribution in December 2025. The IRS does not call you to explain this. It just happens. Now, 7 specific triggers. Listen for the ones that sound like your life. Trigger 1. Taking a large IRA distribution in a single year raises your MAGIE, which Medicare reviews 2 years later. A 68-year-old in Ohio withdrew $20,000 for a family emergency. His Part B premium jumped $888 the following year. He found out in November, after the withdrawal was done. Trigger 2. Earning wages while collecting Social Security before full retirement age. The 2025 limit is $22,320. A 64-year-old in Florida earned $28,000 from part-time work. SSA withheld $2,840. Her representative never mentioned the limit when she enrolled. Trigger 3. Missing your required minimum distribution. The IRS charges a 25% excise tax on the amount not taken. Under IRC Section 4974, a 73-year-old in Texas forgot a $9,400 RMD. He owed $2,350 in penalties, plus still had to take the distribution. Trigger 4. Withdrawing Roth IRA earnings before the 5-year rule is met. A 62-year-old in Georgia opened a Roth in 2021 and withdrew $8,000 in 2025, believing it was all tax-free. The earnings portion, about $1,200, was taxable and penalized under IRC Section 72 IT. Trigger 5. Receiving a lump sum pension in the same year as Social Security. Under IRS Publication 915, up to 85% of your Social Security becomes taxable when combined income exceeds $34,000 for single filers. A 66-year-old in Michigan accepted a $15,000 pension buyout and owed federal tax on $12,750 of his Social Security. He had assumed it was tax-free. Trigger 6. Failing to update tax withholding when your income sources change. A 70-year-old in Arizona started RMDs in July without adjusting withholding. At tax time, she owed $1,100 plus an underpayment penalty under IRC Section 6654D for doing nothing intentionally wrong. Trigger 7. Selling appreciated assets and doing a Roth conversion in the same year. Both count toward MAGI. A 69-year-old in Colorado converted $30,000 to Roth, carefully staying under the threshold. Then in October, she sold a mutual fund at a $9,000 gain. Combined, she crossed into Tier 2 IRMAA. Her premium jumped an additional $66 per month. This is not theoretical. In McNulty v. Commissioner, TC Memo 2021-132, the U.S. Tax Court upheld an IRMAA surcharge even though the taxpayer received zero advance notice from Medicare. The SSA's own Program Operations Manual, Section HI 01101.020, confirms it in writing. IRMAA is based on IRS data from 2 years prior, and the agency has no obligation to warn you before it applies. The system is not designed to hurt you. It is designed to be automatic, and automatic means it does not stop to ask whether you knew. Here is what you do about it. These are the exact strategies tax-focused financial planners use for their own retirement accounts. None of these are mentioned by banks, Medicare representatives, or Social Security offices, because none of those institutions benefit from you knowing. Move 1. Appeal your IRMAA surcharge using SSA Form SSA-44. If your income dropped since the year Medicare is using, because you retired, lost a spouse, or had any significant life change, you can appeal the surcharge directly. The form is SSA-44. It is free, no lawyer required. Submit it to your local SSA office or by mail. Processing takes 30 to 90 days. Find it at ssa.gov. If you received an IRMAA notice and your income has changed, file this form this week. Move 2. Use a qualified charitable distribution instead of a standard RMD. Under IRC Section 408D-8, if you are 70 and a half or older, you can transfer up to $105,000 directly from your IRA to a qualified charity. That transfer counts toward your RMD, but is completely excluded from your modified adjusted gross income. It does not appear as income on your tax return. It does not push you toward an IRMAA threshold. It does not increase the taxable portion of your Social Security. Call your IRA custodian. Request a QCD transfer to any 501(c)(3). Do not withdraw the money yourself first. The transfer must go directly from the IRA to the charity. Move 3. Roth conversion laddering. Stay below the threshold every year. Convert only a portion of your traditional IRA to Roth each year, carefully calculated to keep your total income below the IRMAA threshold. For 2025, $103,000 single, $206,000 married. Done over 5 to 10 years, this shrinks your traditional IRA balance, reduces future RMDs, and keeps your Medicare premiums lower permanently. Request a partial Roth conversion through your IRA custodian. Move 4. Request federal withholding on your RMD using IRS Form W-4P. Ask your custodian to withhold 10% to 15% from each RMD distribution, exactly like paycheck withholding. This prevents an underpayment penalty under IRC Section 6654. Find Form W-4P at irs.gov/forms. Takes 5 minutes to submit. The power combination. Moves 2 and 3 together. Use the QCD to satisfy part of your RMD, removing that income from MAGIE, then convert a calculated amount to Roth within the remaining IRMAA headroom. Example, $14,000 RMD due. Direct $7,000 to charity as a QCD, gone from taxable income. Convert $8,000 to Roth, still safely under $103,000. Result, RMD satisfied. Taxable income reduced. Future RMDs shrink. Medicare premium stays flat. This strategy is documented in IRS Notice 2007-7. It is legal, established, and used by people who know the rules. Now you do too. 3 special situations. Situation 1. You turned 73 in 2025. This is your first RMD year. If you delay your first RMD until April 2026, you must take 2 full distributions in that calendar year for 2025 and 2026. That double income spike can push your MAGI above the IRMAA threshold for 2028. Take your first RMD before December 31st, 2025 if your income is anywhere near $103,000. Situation 2. You recently lost a spouse. When your filing status changes from married to single, your IRMAA threshold drops by half, from $206,000 to $103,000. The same income that was safe under the married threshold may now trigger a surcharge. File Form SSA-44 immediately and document the life-changing event. The SSA can recalculate based on your current circumstances. Situation 3. You are still working part-time before full retirement age. Track your earnings monthly against the $22,320 earnings test limit. If you project going over, ask SSA about voluntarily suspending benefits temporarily. Benefits withheld are not lost. They are credited back at full retirement age and permanently raise your monthly payment. But you must act proactively. The SSA will not call you to suggest it. Let me tell you what happened to Carol. After receiving that Medicare letter, she found out about Form SSA 44 and filed within 60 days. She documented the HVAC repair as a one-time, non-recurring event. The SSA reviewed her case and granted the appeal in full. Her Part B premium stayed at $185.00. The surcharge was removed, but that is not the part that surprised me. Working through her full tax situation, Carol realized she still had a $7,200 RMD required for 2025. Instead of taking it as a standard distribution, which would have added $7,200 to her taxable income, she directed it as a qualified charitable distribution to the Albuquerque Public Library Foundation, the institution she served for 31 years. The $7,200 satisfied her full RMD, excluded from her MAGI. Her Medicare premium stayed flat, and her library received a meaningful gift. Carol told me something I have not forgotten. She said, "I almost just paid it. I thought that was how it worked. The government sends you a number and you pay it. I did not know I could say something." You can say something. You just have to know the words. Here is the one number to remember from today: $103,000. That is the 2025 IRMAA Tier 1 threshold for single filers. $206,000 for married couples filing jointly. Every IRA withdrawal, every Roth conversion, every asset sale this year, measure it against that number before you act, not after, before. Stay under it, your Part B premium stays at $185.00. Go over by $1, it jumps to $259.00. That is $888 per year, and the system will not warn you. It will charge you 2 years from now, when the connection to today's decision is almost impossible to trace. No one will call you about this. The SSA will not send a reminder. Your bank will not flag it. The only person who can act on this is you. And one last thing. If you have a parent, a sibling, or a friend over 60, send them this video, not as a warning, as a gift. Carol almost paid $888 a year she did not owe. Someone you love might be doing the same thing right now, and they do not know they can do anything about it. Share this. It costs you nothing. It could matter more than you know.